taking. Right now, we're turning our attention to the personal finance segment. Hemant Rustagi of Wiseinvest Advisors now joins us. Hemant, once again, we've seen that second crash in gold prices. It slipped below that 1400 level. So a lot of investors, after you see the crash in gold prices again, have highlighted, the dilemma about whether to stay invested or perhaps book profits when the going is good. And right now we've seen a good going on the equity market. So the question is, should they continue to stay invested? How should one, book profits?
Well, I think for any investor, I think there are two major decisions to be made, especially when it comes to asset classes like equity and gold. That is because it becomes a bit of complicated because when we're talking about the current market scenario, for example, we've seen the market going up and we've seen the crash on the gold side. So it becomes a bit difficult for them to really decide as to whether they should be staying investing or they should be exiting from this. I think it's very, very important for investors to have a strategy in place. As I mentioned earlier, the one dilemma is when to buy. Now that can be taken care of, especially if one is investing in, let's say, in a very disciplined manner by investing regularly. But knowing when to sell remains a tricky one. That's why I think it's very important for investors to have a strategy in place. As we know that investors have the tendency to allow the portfolio to ride on, especially when the going is good. But when they're faced with the volatility, they become very nervous, and so you actually see investors taking decision in a haste, either getting out of the asset class completely or allowing the portfolio to continue in the hope that there will be some recovery. I think both decisions actually expose them to some kind of risk. That's why I think it's very important for every investor to have a strategy in place. Now, one such strategy is to rebalance the portfolio. What rebalancing means is to bring the asset allocation back to the original level that is of different asset classes like equity, gold, or debt. Now, how it is done is that when, let's say, an investor has an overexposure to equity from the accepted level, he will book profit when the going is good, and he will invest the money when the markets are down. Also, rebalancing is very, very important because every portfolio is designed to tackle an accepted level of risk. By doing nothing when the going is good, basically exposes her to much higher risk. But I believe that the profit booking should be done when the allocation drifts by, let's say, 10% or more. Doing it frequently actually also defeats the purpose. So that is one. The second is that any other investor who wants to book profit but is not sure about when to do it, especially here I would like to mention about the mutual fund investor, those who invest in equity or equity-oriented balanced fund, I think they can opt for a dividend payout option. Now these funds typically pay a dividend in once in a year. Now the tax-free nature of this dividend actually makes the whole exercise very, very tax efficient, but also they don't have to worry about timing the market. So I think, as I mentioned earlier, it's quite evident that booking profit is necessary. Otherwise, one is exposing oneself to more risk.
Are there dividend options?
Very important to
Hemant, are there dividend options in gold ETFs also?
Not really. We've seen ETFs and we've seen gold saving fund. There is an option, but we haven't seen any fund, I think, giving dividends so far. Okay. So there, I think, as I mentioned earlier, I think the key factor is to stick to one's asset allocation. And if the gold prices have taken somebody beyond his accepted level of an asset allocation, then I think it makes sense to rebalance the portfolio once in a year so that you actually book the profit and at the same time you're not exposing yourself to a higher risk.
Discussed with Hemant Rustagi, our personal finance expert. And now we have a viewer joining in. Krishna Goel from New Delhi he has sent us an SMS query. You're not able to get him now. He is 28 years old, Hemant. He's a professional, says that he can invest 6,000 rupees a month for the next 20 years for his son's education. He would like to collect a corpus of 25 lakhs. So basically he's asking whether it's a realistic goal with the 6,000 rupees per month, and what should he invest in?
Well, I think the key factor clearly here is his time horizon, which is around 20 years. For a time horizon like this, one can safely invest into well-diversified equity fund because one needs to really build a larger corpus, and also equity has the potential to beat inflation over the longer term. So in that sense, I think my recommendation to him would be, and especially also considering the fact that he would be investing on a regular basis through SIP, which will take care of the volatility. So he can look at well-diversified fund for a time horizon of 20 years. A couple of funds I can mention to him. One is ICICI Focus Blue Chip, which is a pure large cap fund. He can invest 4,000 rupees in that. The second fund is IDFC Premier Equity, which is a quality mid cap fund. He can invest 2,000 rupees in that. And if I assume a return of 12% over the next 20 years, he should be able to actually build a corpus which is going to be much more than what he is trying to build. He should be having a corpus of around 55 lakhs. But I think two important things I would like to mention to him. One is to keep track of the performance because when we talk about 20 years, the commitment has to be to the asset allocation, not to the fund. So keep looking at the performance of these funds, and if need be, he should not hesitate in changing them, but he should not be always in a hurry to change this fund. So I think a couple of things, if he remembers, as I mentioned earlier, he can actually create a corpus which is going to be much more than what he is trying to build.
All right, Hemant, we'll have to leave it at that. Thank you very much indeed for joining us. We leave the markets in almost flat terrain. The Sensex